Alright, welcome guys, it's Marcel here, and here I am with the first episode of the educational mini-series, where I'm going to break down a doubted topic for you in each of these videos. This mini-series will be the continuation of the 15-minute video course that has been released half a year ago. And regarding this 15-minute video course, you guys had some doubts, questions that right now I'm going to break down for you by week or bi-weekly. We will see how frequent these questions will be, but in each of these videos I'm going to break down and introduce a new topic for you, a new concept for you that has not been included in the main 15-minute video course. So this is a little addition to actually get some more knowledge about the 15-minute entry models and to be more precise with your trading plan. So the first video which you are currently watching will be about the liquidity sweeps, because liquidity sweeps are really crucial part of the trading plan. Actually, without sweep of liquidity, without having a sweep of liquidity, we cannot even trade. So it's a really important topic to wrap your head around and learn properly. So first of all, why liquidity sweeps? Why are we starting with this topic? Because once again, this is a crucial thing regarding our trading plan. And you guys lately, as I saw in the Discord channel, you guys lately actually got confused that what is a sweep and what isn't a sweep. I'm going to bring some live examples for this as well. And you guys seems to have a misunderstanding and you can't really make a difference in between a sweep and the breakout structure, and what is not a sweep and what is a sweep. So in this video I'm going to clarify this for you. I will try to keep it short and simple as the rest of the education here in the Flipping Markets Academy. So without wasting further more time, let's just get started with an example and with some knowledge refreshment, I would say. So we are looking at the 4-hour time frame right here. This is 4-hour. The 4-hour time frame is bullish, creating a series of highs, lows, breakout structures. Here is the less recent trading range from low to high, 71 located here. What we are looking for here is obviously our trading plan to be printed. When a 71 level on the 4-hour time frame is getting mitigated, we are looking for these 5 criteria to be printed, and we are looking to trade once all of the 5 criteria are fulfilled. What is the first criteria that we are always looking for is the sweep of liquidity. So without properly knowing the concept of the sweeps, we can't even apply the rest of the criteria, because without a sweep, we are not looking for a setup. So what is a sweep? This is the question. A sweep in a bullish scenario, which we are talking about right now, is when price sweeps a previous low in the market and shifts a previous high point and puts a market structure shift into the 15-minute time frame, and then the 15-minute time frame will realign with the 4-hour one, and both of the time frames, the 15-minute and the 4-hour, will be going into a bullish direction. Now take a look at this example. What we have here is a previous high point right here that mitigated the 71 level. After the 71 level mitigation, we are looking for bullish confirmations. What are bullish confirmations? Bullish confirmations are the criteria system. If these criteria are printed inside of a bullish 71 level, we have a bullish confirmation. Now, first criteria, liquidity sweep. So how do we actually use these liquidity sweeps? You know, we have this less recent high point here as the shift of the market structure. So if this high point breaks, we will have a market structure shift. Let's just say that we have this less recent low point right here that created a pullback. So price is currently in between of a previous 15-minute high point and in between of a previous 15-minute low point. Now, how would we look at these sweeps? We have two kind of scenarios how a sweep can happen and how we can actually tick this criteria off from the checklist. First, and the best scenario, this is the highest probable setup and highest probable sweep we can see, is when price sweeps out the less recent low point, the lowest low in the market. So with the sweep, it takes the liquidity of this low point. We will talk about that, what a liquidity taking candle is, or how we can actually determine if it's a sweep or not a sweep, above right here in the examples. But right now, let's just talk about that, how we actually identify sweeps. So first one, when price takes out the less recent low point, the lowest low in the market, and from there, it reverses. Obviously, when this happens, the shift in the market structure point changes, because once price goes below the lowest low in the market, we will have a new high point. Because when price breaks below or sweeps below this low point, we will have a new high point that created a lower low in the market, which will be a lowest low in the market. So if a lowest low is getting created, we will have a new high point. In this case, this will be the new high point. So once price sweeps below this lowest low, then we can look for the shift in the market structure by breaking the higher high, technically lower high in the market. And in this case, when the sweep happens, we can apply the rest of the criteria system. The second sweep which we are looking at is not that high probable, but still a sweep. This sweep happens in between the high and the low, and price basically prints an internal structure in between the high and the low. When this happens and price takes out, for example, this internal low point right here, by taking the liquidity of this low point from where it shifts the market structure, we can also identify this as a sweep of liquidity, and then we can apply the rest of the criterias with this shift, with the volume, with the order block, with the Fibonacci, we can enter in the market. Okay, now it looks cool in theory that, yeah, we are looking to take out this low point or this low point, and when those low points are taken out, we can look for trades. But in reality, it's not that simple, because sometimes when price takes out a low point, let's just talk about this low point. When price takes a low point, it stays below the low point. Stays below this low point with few candles, and few candles will be printed below the low point before the reversal and the big volume kicks in. Or sometimes price will just simply go significantly below this low point by printing a big candle from where it immediately reverses to the upside. So yeah, in theory, the sweeps are really cool and sound simple, but in reality, once again, the formation of the candle is hard to identify. But not after this video, because once we finish with this video, you will know that what you are looking at and what is cool and what is not cool to take. All right, now let's talk about candle formations. Let's just imagine that this, what you see right here, is the exact same stuff as you saw right here. So we have a high and we have a low, right? So in this case, let's just say that the high is located here, because this is the high that did put a new low point into the market by sweeping out the previous low point. So this is the previous low point, which we are looking to be swept. And with the sweep, this high will become the new high point. Okay, so now that we clarified this, we are looking at candle formations. Let's just first talk about a candle. What is a candle? Candles have opening and closing prices, and the candle also shows that where the candle has been. So one single candle shows you 4 data: opening, closing, highest point, and lowest point. I know this is a pretty basic stuff, but it is required to understand the sweeps and the candle formation for the sweeps. Now, let's just take a look at this candle right here. It doesn't matter which candle we are taking a look at. We can also take a look at this candle. Now, what this candle tells you, that it's a bullish candle because the color is brown. On a bullish candle, the low of the body will be the opening price. So at this point where the body starts, the candle has opened. The downside wick will be, and obviously the lowest part of the downside wick will be the lowest point that price has ever been. On the upside wick, the highest point of the wick will be the highest point where the candle has ever been. And the top of the body right here on this line is where price closed. So this is the opening price, this is the closing price. This is the 15-minute time frame, which means that in this 15 minutes, this is where the candle opened, and 15 minutes passed by, right? 15 minutes passed by, price came down here, then went up here, then came down here and closed right here. Or this can be the vice versa as well, where price went up here from this region, then went down to the lowest point and came back up to this region. Obviously, it's visible on the lower time frame, but this is what you can read from one single candle. Now, going back to the visuals, after we understood that what data we can read from a candle, coming back to the visuals, I'm going to explain the cleanest sweeps that you can take and what you can consider as a sweep. Now, let's just take a look at this first example. Price is sweeping out the low point. This low point has been swept out by a wick. So this is the cleanest sweep you can have, and this is the cleanest sweep you can enter in. I mean, obviously after applying all of the other criteria from your criteria system. Now, where is the opening price? Let's just say that this is a bullish candle, so the last candle closed right here as a bearish candle. I just draw it more particularly. So this is the last recent candle. It closed right here as a bearish candle, and the bullish candle opened here. Went down, swept out the liquidity from this previous low point. After sweeping out the liquidity, it went up to the highest point and closed right here. So this is a bullish candle. Bullish candle closed above the last recent low point, which means only the wick went below the last recent low point, which is a clear indication for the grab of the liquidity. What we also look at these liquidity sweeps is that we are looking for a reversal. So if price sweeps out this liquidity with this kind of pattern candle formation, it's usually the sign of the reversal because it's a bullish candle, and you can see that price grabbed the liquidity from underneath the previous low point and it closed with bullishness, and we are looking for bullish trades. So most likely the continuation candle that will be formed after this sweeping candle will be a big volume candle. But even if it's not a big volume candle, but just a little, or not even little, but regular size candle like this one, it's even fine. It's even good. You can even consider this as a liquidity sweep. Here's one more thing. Even when price starts to range a little bit after forming this bullish sweeping candle, that sweep can be accepted as a sweep because this is a clean indication for liquidity to be grabbed, because you can see that price took the liquidity with a wick, then it reversed into a bullish direction by forming a bullish closing candle. Alright, so after this bullish candle is closed, basically, if you have a market structure shift and obviously volume order black, you can pull the Fibonacci and you can enter in the market. Let's just see the next example right here, which will be a bearish candle. So let's just say that the last candle closed right here as a bearish candle, and the very next candle, which will be a sweeping candle, opened right here. So this is a bearish candle. Now this bearish candle actually took the liquidity of the low point again, went below the low point, and the body closed above the low point, because this is the opening price of this candle and this is the closing price, which means that price closed above this last recent low point. So the sweep has happened with a wick again. When the sweep happens with a wick and then price reverses immediately, is always a great sign. Why the bullish sweeping candle is better than the bearish sweeping candle? Because from the footprint of these candles, you can read that, yeah, on the bullish sweep, price was being able to reverse by forming a bullish closure. In this very case, on this second case right here, what you can read is that price opened here, closed here, but it wasn't strong enough to reverse to the upside, right? Because if it would have been a bullish closing candle, then it would have looked like, let me just delete everything from here and you will see. So it would have been a bullish closing candle. Then what you would see right here is that the candle opens here. This is the opening part of the candle. So this will be the low of the candle. The wick would have went below the last recent low point, and this would have closed as a bullish candle, just like here. But in this second case, this doesn't close as a bullish candle, it closes as a bearish candle. So it means that, yeah, this was the lowest point of the candle, which means price went below the previous low point and took the liquidity of that low point. And this is the lowest point it has ever been. But the candle closed right here, which means it couldn't reverse to the upside. So not that amount of liquidity has been collected than on the bullish closing candle. Why? Because the bullish closing candle is the same one, because it opened here, went below here, went below the previous low point, but it had collected enough liquidity to reverse to the upside and close as bullish. Now in the second example, when candle closes as bearish but still closes above the last recent low point, it's still a great way to approach the market. Usually when this happens, when price just only takes out the low point with a wick and the body closes above, either if it's bullish or bearish, obviously talking about the bullish example in this case, either if it's a bullish or bearish candle, but the wick sweeps the last recent low point and the body closes above, it's a great sign, and most of the times a big reversal is coming from here. So most of the times a reversal is coming. Now these are the two easy examples. When price sweeps the low point with a wick, body closes above, chef's kiss, perfect. Basically, in 90% of the time, this will be followed up with a market structure shift, volume and order block, and you can apply the criteria system, the rest of the criteria system, and you can enter in a trade. But now the trouble begins with the third example, where price closes below. In this very example, basically this can only be a bearish candle because price opens here, right? This is the opening of the candle. It goes below the last recent low point, sweeps it out, takes out the liquidity. And if it would have been a bullish candle, then it would have came above the opening price region of this candle. But no, it closes below the last recent low point. So what happens when it closes below the last recent low point? Don't worry about it. We have rules for this. Not like concrete rules where you can apply the same stuff over and over again, but this will be a little guideline that how to approach these candles because yeah, every candle is different. Yeah, every market condition is different, and every setup you will see will be different. You will never see the same setup over and over again. Everything will be different each time. But when price closes below this last recent low point, and it immediately at this closing range, let's just say that, yeah, here's a downside wick, and at the closing of this candle, the next candle opens right here, and this next candle reverses immediately to the upside. So you see the reversal. If this reverses, it's a great sign. If this is a reversal candle, this is a bullish candle that reverses after the sweep. And even this bullish candle is getting followed up by some more bullish candles, which shifts the market structure. Perfect. Take this as a sweep. Even though it's a closure below the last recent low point, take this as a sweep because there is a clean price action indication. There is a clean footprint of price action that price grabbed the liquidity from underneath this low point. Even with a body closure, it doesn't matter. You can see that after the candle closes, price action reverses and the bullish price action starts. Even when price forms a not so big candle, like a little candle that won't even, devour the first candle, it won't go above it. It will be the half of the size of this previous candle. It doesn't matter. A small candle, but price still reverses with bullishness, and then few more bullish candles are getting printed, and you see clear indication that liquidity has been grabbed from underneath this low point. Yeah, you can still take the setup if price changes the structure, if price shifts the market structure. Why? Because you can see that, yeah, this candle closed below the previous low point. Yeah, we see the body closure. But after the body closure, there is a clean sign, clean indication of the reversal of price action, in the reversal of price action. Because you can see that these bullish candles are getting printed one by one, which eventually leads into a market structure shift. It doesn't even matter if price prints one bearish candle in the meanwhile, like here one bearish candle is getting printed from where another bullish candle is getting printed. It doesn't matter. What matters is the criteria system, 1, 2, 3, 4, 5 criteria, which should be the volume, the order block, the sweep, and the shift. If after the sweep, after the body closure, price reverses and being able to form volume here, being able to form order block here, like here's an order block, here's a volume, and from there, even if it prints a bearish candle here, even if it prints multiple bearish candles, but visible volume and order block is there, and then shifts the structure, you can take this setup, you can pull a Fibonacci from low to high point, and you can enter in the market here. Now, let's just talk about that, what I dislike about these closing candles. What we should dislike is when price closes below this low point, and then obviously continues below this low point, prints multiple more bearish candles. It shouldn't be sizes bearish candles. It can be tinier volume candle. Bearish candles, but bearish candles. When price prints more and more bearish candles after the closure of the first candle, that is a really bad sign. Why? Because you see the footprint of price again, that price, yeah, went below the low point, but after the break of this low point, it wasn't being able to reverse to the upside with those bullish candles, but continued to the downside over multiple 15-minute candles. This means that no liquidity was resting underneath this previous low point. If there's no liquidity resting underneath this low point, you won't see a reversal. Yeah, eventually you will see a reversal. Eventually price will reverse. Let's just see three more bearish candles are getting printed. Then price will reverse to the upside. And you will think that, yeah, price will come up to shift the structure. Then no, price will just simply react on an order block here and will drop down. Why? Because this was a clean break. you can see that price did not collect liquidity from underneath this low point, and by not collecting liquidity from under this low point, it is visible on the charts that there was no clean reversal in price action in the candles, and price just kept going down. Here's another example when price breaks below this low point again, but then few candles stays in one place, like few candles are getting planted. It won't be always perfect. It won't be always in one candle's range. Sometimes two bearish candles, then one bullish candle, two bullish candle, one bearish candle, one more bearish candle. It will accumulate in this range. There will be some accumulation after the closure of this candle. If this happens, and then price suddenly goes above and breaks the structure or shifts the market structure with a volume gap, this will be a false signal because market is looking for your liquidity. It's about to trap your liquidity and you will be swept out from this setup. Why? Because once again, there is a clean footprint that no liquidity was taken from underneath this low point. Because after the closure, price accumulated. If it accumulates after the sweep or the takeout of this low point, it means that no liquidity was collected and that liquidity wasn't used to reopen into bullish positions. So, if price action accumulates or continues deeper after your titled sweep, just know that it isn't a sweep. What you're looking for is a reversal in price action. Once again, even if it's with a bullish candle, even if it's with a bearish candle, even if it's with, tiny candles or not even tiny, but not those sizes candles, but the gap is clearly visibly there, you are good to go and you are good to go again. But when price breaks and stays below or accumulates after the break, then it shifts the structure. You are not good to go because most likely this will trap your liquidity and you will be part of the liquidity. Now let's just take a look at a few live examples. And the first live example will be on gold. This setup was opened by many of you guys. This is the third scenario, the closing below scenario I explained in the previous visuals. So here's a 4-hour 71 level. Here's the last recent low point, right? You just track the structure. Price mitigated the 4-hour 71 level. You take this low point where the mitigation has happened and you go back to the highest high. Somewhere around here, actually above it, there will be the highest high. So we are having a dealing range of this high point and low point. This is the high in the market, this is the low in the market. This is the market structure shift point, and this is the low that we are looking to be swapped. Now, what took place right here is that price accumulated after a mitigation of the 71 level. It doesn't matter, price can accumulate. If it accumulates after a mitigation, it's good because it means that it traps more liquidity inside of this range that will be swapped. What took place right here is that after the accumulation, price took out this low point. Took out the low point. I'm purposefully not saying swept out the low point. It took out the low point, and after taking out the low point with a body closure, a clean body close below this last recent low point, what took place right here is that a first bullish candle has been formed. Yeah, this is nice. If this is the first bullish candle, and it could have printed few more bullish candles, then it would have been a really great setup. But this is not the case right here. The case that has happened here is that price printed equal candles, printed 4 equal candles, or to be more precise, 3 equal candles next to each other. 3 equal candles after a closure of this big volume candle, after a closure below this last recent low point, tells us that under this low point there was no resting liquidity, because after the candle that took out this last recent low point, price couldn't form reversal candles to the upside for 45 minutes straight. Meaning for 45 minutes straight, no reversal took place. If there's no reversal that took place after the sweeping candle is getting printed, it means that if the reversal happens after this accumulation stage, it will be a manipulation by market makers because they want to see your liquidity being trapped. They want you to open positions after the market structure shift. They want you to open these positions, and this is dumb money. This is dumb money concept. Why? Because many traders think right here that even without paying attention for the sweep, many traders think that, yeah, price shifted the structure. Now we are bullish. Now we are looking to buy. And the next move that will happen, that will take place, will be their stop loss. Their stop loss will be collected, and that will be the liquidity that will be used to reverse price to the bullish direction, because previously no liquidity has been collected. So, speaking about, let me just replay price action back to this candle again, to this bullish candle. Speaking about a little bit different scenario, but the same price action here. So price closed below this last recent dealing range, the last recent low point, took out the low point. After taking out the low point, it formed, let's just say, three bullish candles or two bullish candles, doesn't matter. On these bullish candles, you can see volume because the wicks are not meeting in the middle. But price doesn't shape the structure immediately. It prints like two bearish candles, one more bullish candle, one more bullish candle, one more bearish candle, and on this candle it shapes the market structure. Is it a great sweep? Yes, it is. Why is it a great sweep? Because after the takeout of this low point, price reversed to the upside. And after reversing to the upside, yeah, it might have printed some bearish candles, then bullish candles, then bearish candle, then a bullish candle that shifted the market structure, but it immediately reversed to the upside. And this immediate reversal is a sign for the liquidity that was resting underneath this low point, got taken out, and was reopened into a bullish direction, because after a sweep, that liquidity is always immediately reopened, and that reopen is visible in price action by forming some reversal by some bullish candles. And once again, it doesn't matter if price forms bearish candles after the reversal, or forms one more bullish push and then one more bearish candle and then one more bullish push that breaks the high point and shifts the structure. It doesn't matter. What matters is the reversal, the first reversal after the takeout, the first few candles after the takeout of this low point. And now let's just take a look at some few more live examples. All right, here are a few more live examples from my own trades. Yeah, these are trades from the past 1 or 1.5 months. You can see all these trades in the trade results channel. And yeah, this is a really good starting point for you as well to take a look at my trades in the recap section and the trade results section, because what you will see is examples, hundreds of examples for perfect sweeps. You won't see a single setup without the sweeping concept I have explained for you. So first setup we are talking about here is a really clean bullish candle, a reversal, where price just formed the last recent low point here, from where it created a pullback. Now this is the low that we are looking to be swept. Price goes below the low point with a wick. After the sweep of this low point with a wick, the candle closes with bullishness. Why it closes with bullishness? Because this was the closing range of the previous bearish candle. This is the opening range of the previous bullish candle. The wick, the lowest point, went below the previous low point right here. After going below the previous low point, it went above and closed right here. So there is a clean bullish reversal sign as this candle shows. Then obviously price just continued with creating volume candles and volume gaps and then shifted the market structure. But this is a clean bullish closing wick sweeping example for these sweeps. Next example, yeah, it's a loss. It doesn't matter if it's a loss. Obviously, good sweeps will have losing setups as well. But if you are only taking the good sweeps, the sweeps I'm explaining right now, your win rate will significantly increase. Now, this example again, bullish closing candle. Here's the 71 level, 4-hour 71 level. Here is the last recent low point that we are looking at. We are looking for this low point to be swept out. Price went below this low point. Here is the last recent bearish candle. Let me just zoom into this picture a little bit. So here is the last recent bearish candle that closed right here. Here is the bullish candle that opened here. This bullish candle went below the previous low's liquidity, previous low's dealing range with a wick. Then it immediately came back up and closed right here. So what we see from this candle is that it opened here. The lowest point is here, meaning it went down there, from where it came back up and closed right here. Clean bullish closing candle as a sweep. Obviously, you can see this is why I brought this example, because this is what I explained in the previous live gold example, where price formed this reversal candle, and then after forming this reversal candle it printed one more bullish candle and then few more bearish candles. From this it printed few more bullish candles, one more bearish candle, and this bullish candle shifted the structure. So it doesn't matter if it prints few more bearish candles in the meanwhile. What matters is the immediate candle that is getting formed after the sweep of the liquidity. Okay, moving on to the next example. Here is the third one. Sorry, let me just zoom this in. Here's the third one. What we see right here is a bearish closing candle, but then after the bearish closing candle, there's immediate follow-up. So here's the 4-hour 71 level. Here is the high point, here is the low point. Yeah, this is an example where the lowest low is not getting swept out, but an internal low is getting swept out. So after the high and the low has been formed, price created a pullback, creating an internal pullback, internal range, and then this range got swept out. This is the low we are looking at. This low got swept out by this candle. Yeah, the body closed below a little bit, but I would rather say that this is a bearish closing, wick sweeping candle of the previous low. So you can see that the candle closure is bearish, but the wick went below it. And then right after this closure, there's your immediate reversal, which shifted the market structure to bullish. Next example is this one, where you have the nice bearish sweeping candle reversal, right? So price swept the high point. Obviously here is the 71 level. Price mitigated the 71 level. Here is the high, here is the low point. The high gets swept out, and the candle that swept out this high point closed with bearish. Yeah, obviously it's bearish candle because we are talking about bearish scenario short trade right now. So obviously this is the first scenario that I explained for you, that price swept out the high point with a wick and then closed with bearishness. So this is the best kind of setup that you can take, and this sweeping candle being followed up by this bullish candle. I do believe that you get the rhythm, you get the logic. I do not need to bring more examples because you can take a look at all of the trading results, all of the recaps, and you will see hundreds of examples for this sweep. But once again, if you do not understand the concept of the sweeps, replay the explanation part few more times and you will get the rhythm of it. Obviously, you should backtest it. You should go over tens or hundreds of trades before you get the rhythm of it. But once again, everything lies in the candles. Footprint. You can read everything from the candles. You can see the intention of the price action by one single candle closure. You can see the intention of everything, every single chart by looking at one single sweeping candle. Everything lies in the candles. So study the candles, study these concepts, and wish you guys a beautiful rest of your day. Take care, and I hope you like this video.